I believe the automation related stocks will be the biggest gainers over the next 5 to 10 years, mainly due to a lot of the things that's happening in the United States, due to policies around immigration and a lot of reshoring, manufacturing in general, and very expensive labor. We desperately need automation, not just automation in cars, but industrial automation, warehouses, and even in deliveries and many different areas. And I believe I have the perfect stock for that, which I talked about recently. But I have a good track record of picking those growth stocks in general. One of my biggest gainers over the last 2 years was the growth stocks, such as Mama, up 720%, which I shared on YouTube. Mama up 330 and Hood is up 310. And this stock, I might potentially add it to the list if it does work out as one of my, you could say, early kind of picks that I add to my profile. Because if I end up being right on it, I could be up 15 to 20x. But if I'm wrong on it, that the stock could go down and never recover, which is why I have a small percentage of my portfolio in the stock, because I don't need to put in a lot of money in those stocks if I end up being right. And this stock is Ouster. Ouster stock is very volatile again. It was trading at $37 not long ago. The company reported an amazing report, and on the report, the stock went to $19. So I got called a scammer and all these things on YouTube as usual. Then the stock right now is trading at $26. So if you're buying a stock, you have to be able to take the volatility. It's $1 billion market cap, and it's a growth company, so it's very, very volatile. Ouster brings physical AI to life. They do it through sensors. And one of the biggest area for them is robotics. This is a served robotic robot. Maybe you've been to San Francisco or a lot of the big cities, and you've seen some of the served robotics. They just go and they deliver food. Well, they need something to see. And this is the sensor, which is why Ouster is called the eyes of AI, because to bring AI to life, into robotics, into automation, you need sensors. And the most popular ones are the Ouster LiDAR sensors, especially for industrial and robotics applications. So the area for them is a $14 billion TAM. The company's market cap is $1 billion again. This is last mile delivery, mapping, military, and defense. And they also have the asset inspection company. And Amazon itself is using Ouster LiDAR in their warehouses. A lot of people don't know that. And Amazon is invested in Ouster through warrants. So whenever they buy those sensors, they pay for them through warrants. They want to acquire a stake in the company, and you can put it on ChatGPT or Gemini, and it will tell you the same thing. So Amazon is using them, and Amazon only uses the best. So that would tell you a lot about the company. The second area for them is industrial. This is huge, like warehouse automation, agriculture, mining, and construction. The third area for them is automotive. This is an exciting one because Ouster is not really an automotive LiDAR company. They specialize mostly in industrial and robotics, but now they are finally expanding into the automotive segment. And this is robotics, robot trucking, and customer ADAS and many different areas. But this is getting exciting for one reason, or for two reasons. The first reason is the company is developing a DF technology through solid state, and this mainly has no moving part. It's a camera-like architecture, and it's going to be a game changer for the industry, I believe. And it would be, it would really help Ouster a lot in terms of growing into the automotive segment. But the biggest change around this segment is mainly Ouster's competitor, which is Luminar Technology. Luminar was a hyped up company back in 2021. The stock is down 99.76% to $1. It's about to declare bankruptcy. It's a terrible, terrible company, and they can't even meet their obligations. Volvo, which was using Luminar Technologies LiDARs, is going to drop it as one of their key suppliers. And they said Luminar has failed to meet the contractual obligations to Volvo cars. So this is another potential opportunity for Ouster, where Ouster can jump in and they can take market share from the Luminar companies that are dropping them, because Luminar has so much debt, the company could literally go to zero. They pretty much filed for bankruptcy. So this is a major, major competitor to Ouster in the United States that's going to be gone, and that's going to allow Ouster to remain the biggest LiDAR company in the United States and for them to expand into the automotive segment. Now, Ouster is taking a different approach. Ouster has no debt, guys. They have $244 million in cash and zero debt. They don't want to end up like Luminar technology, and it's much, much safer than Luminar and those kind of other competitors. Now, another area for them, and this is my favorite one, and this is the smart infrastructure. So it's mainly due to the traffic monitoring systems. And the reason why I love this area for them very much is because they don't only sell the hardware, but they also sell the software. And the software, they sell it for them to be able to monitor the traffic and look at certain things. And that's gonna give them recurring software high margin revenues. So it's not just a hardware company, but it's also becoming a software company over time. And this is very, very sticky, guys, which is why Ouster has expanded their gross margins from like 1% to around 42% gross margins due to the software business and due to their focus and their edge and their competitive advantage in industrial and in robotics. If that was just a commoditized, very competitive space, then Ouster would have 5 or 10% gross margins. But Ouster is maintaining 42% gross margins because they have a competitive advantage in industrial, which is very important, and Amazon is using them, and Android is using them, and even Google Maps uses them. If you go on Google Maps and you're going somewhere, and sometimes you check the beautiful images about a certain house or whatever on Google Maps, those were generated through an Ouster LiDAR sensor. So all those companies are using Ouster for a reason, and they are maintaining 42% gross margins. Now, if you compare Ouster to their competitor, Ouster has about 42% gross margins. Innoviz, which is the second leader, I would say, it's growing rapidly, very good company, by the way, 16% gross margins. AEVA is negative 49% in gross margins, and Luminar, forget about it, negative 78% gross margins. So Ouster is the most profitable one by far in the United States. Now, they do have some competition outside the United States, mainly from the Chinese LiDAR suppliers like Hesai. Hesai is a popular one. It's profitable, it's growing rapidly, and they're very efficient, and they're very, very cheap. But this is not a major concern for Ouster, as Hesai, which is again the leader in China in terms of LiDAR technology, has pretty much been banned from the United States. The US courts has ruled against the China-based Hesai group. They added to the blacklist of companies allegedly working with the Beijing military. They said Hesai contributes to the Chinese defense industrial base. So they pretty much banned it from the United States. It's not going to be used for anything related to the government, anything related to traffic monitoring system due to national security concern. And Ouster right now has positioned itself as the biggest supplier of LiDAR technology that's based in the United States. This is a major, major edge that I don't believe it's really priced in the company. And recently, they introduced a bill to phase out Chinese-made LiDAR from the United States entirely over the next 3 years. So this is another kind of, you could say, competitive advantage, where the US companies, yes, they cost a little bit more for the LiDAR and they charge a little bit more, and the Chinese ones are more efficient, but this is not something like they're selling screwdrivers or whatever. This is something that's critical, such as, for example, traffic monitoring systems. I'm sure the United States does not want Chinese cameras being installed in the United States, where maybe they can be hacked from China and they can see whatever is happening everywhere, and maybe in the Android drones, Android's not going to be using Chinese LiDAR, and a lot of cars here, maybe they will try to phase them out where they don't even have to use LiDAR from China. And then this is another opportunity for Ouster. So this is a game changer for the company if it ends up being passed, and it would just really be amazing. Now, the last quarter for the company was really good, 41% year over year in revenue growth and 13% quarter on quarter. GAAP gross margin of 42%. It was down a little bit, but nothing too crazy. Net loss was 22 million. It has improved 4 million year over year and 1 million quarter on quarter, and the stock went from $35 to $19. And that would really tell you a lot about efficient markets. Now, the company is not profitable, and this is one of the concerns, but it has been improving in losses from negative 95 cents. Every single quarter they improve on an earnings per share basis. Now they're at negative 37 cents. And I believe we will see profitability in Q1 of 2027. Another risk I would say with Ouster is their shares outstanding have been skyrocketing. So there's a lot of dilution with Ouster. and I don't really like it at all. But I think now the company has a solid balance sheet, and the management, they spoke about this, and they said that they want the suppliers of Austor, for example, just like when Volvo dumped Luminar because Luminar is in trouble and they can't do anything, they want those companies to have a good perception of Austor, that Austor has a good balance sheet and they are well positioned and they're not going to go under and nothing crazy is going to happen, which is why Austor has been diluting stock for them to increase their cash position. And they have 244 million in cash and no debt. So I believe that will slow down at some point, especially when the company becomes profitable. Now, if I look at the multiple, the company right now is trading at 7 times enterprise value to sales. I don't believe 7 times is too expensive for a company that's in the beginning of a major trend of an industrial revolution, I would say, mainly in terms of automation and a lot of different things that are just beginning. This is a 10, 20, 30-year tailwind, and they are very early. They are a leader based in the United States, which I told you is very important. 7 times sales is not expensive for a company that is targeting 30 to 50% annual revenue growth. The company, guys, is only making 150 million in annual revenues. This could easily be a 2, 3, 4, 5 billion dollar revenue company over the next 10, 15, 20 years. All the robotics that you're talking about, the automation in Amazon and Android drones and all these things, and smart infrastructure alone is a $19 billion TAM, and their competitors are going bankrupt. The TAM is huge. Austor, I believe, will be able to maintain 35, 40% revenue growth for the next 10 years. Maybe it sounds crazy, but from 150 million in revenue only, and with exposure to such a massively growing trend and being positioned as a leader in the United States with all those laws passing, I think 35 to 40% is highly achievable for a company like Austor. So this is my model on Austor. I put in 150 million, which is the 2025 revenues for the next 10 years at 35% revenue growth. I think this is fair. I'm getting $3 billion in revenues. The current enterprise value is about $1.3 billion. So I'm going to take the $3 billion in revenues. I'm going to take 2 assumptions. The first one is that Austor trades at 5 times sales. I think 5 times sales is highly likely, and this is a multiple contraction from the current price. Now, if it trades at 5 times sales, this is $15 billion enterprise value. The current enterprise value is about 1.3 billion. This is about a 10x, or I would say around a 1,000%, 1,053% on the upside. Absolutely insane. Now, if it does trade at 10 times sales, which might be too extreme, but if the company is putting up software as a service revenues 10 years from now, from all the equipment they installed this year and next year and the year after, and they scale and they become something more than just a LiDAR supplier, I think 10 times sales is possible. Maybe it's unlikely, but it's possible. So I'm going to take the 3 billion, 10 times sales. This is a $30 billion enterprise value. The current enterprise value is about 1.3 billion. This is about a 22x on the upside, over the next 10 years. And this is just massive upside. But this is, again, without dilution. If the company continues to dilute, maybe it's not going to be a 22x. Maybe that's like a 15 or 17x. And I would still take it, which is why I own Austor. It's a small percentage of my portfolio. Small meaning under 4% of the portfolio. So if I'm right and Austor does go up 10, 15, 20 times, 22 times, I'm going to make a lot of money. I don't need to put in more than 4 or 5% of the portfolio, 3%, 2%. It's really not bad at all. But if I'm wrong and Austor goes down 50% and never recover for some kind of a reason, then I don't lose too much. And if you're interested in finding out a little bit more of what I do when I'm buying something, when I'm selling something, I share everything I do in my own group. And this is the link if you're interested. But thank you very much for watching. It was not financial advice. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.